Hello and welcome to our Exponent Q3 quarterly review. I'm Benoit Paliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management. So this quarter hurt. The performance so far this year, as you run down all the different asset classes, they're all negative. The one-year performance of the past 12 months, they're also negative. The cleanest dirty shirt, as they say, in different asset classes has been the TSX, thanks to the oil price. This quarter, the US dollar is up 7% versus our loonie, which means that when we express returns in Canadian dollar terms, they are still positive. But don't make no mistake, the returns were negative this quarter, but the US dollar brought up those returns. The oil price had a rough third quarter of 2022, as did gold. Interest rates are up. So one-year bonds are paying 4%. Five-year bonds are down to 3.33%. And GICs are now 4.5%. So the oils did well for the TSX, except the US dollar is up. But everything else, it's all down. Interest rates, they're up. Bond prices are down. There was nowhere to hide. Bonds did not help. Typically, they help. But with high interest rates, bond prices fall when rates rise. And that has an impact on all assets. So here's what we've got. As an example, we have a 60-40, 60% equity, 40% bond portfolio. So far this year, that portfolio is down 19% or 25% annualized. Unheard of. Historically, it's never happened. This is the TLT, or the 20-year bond in the US. So far this year, it's down 30%. 38% if you annualize it over a 12-month period. So bonds really hurt performance, even though the markets were down. So there's really some villains here. If we were talking about a path down, or an investment in venture. We've got interest rates really had an impact on investors. The rise in interest rates, both the path and how quickly and how hard they rose. Inflation, that's obviously a reaction, or the interest rates is a reaction to the inflation. Labor participation. Labor has an important component in terms of economic growth and where and how, if people are working and where they're working has an impact. Investors. Maybe 2021 investors overcooked, paid too much for a dollar of earnings, and now there's a mean reversion happening. Central bankers, finance ministers, and despots all had their part in this market downturn. So if you watch the long video, we're going to go through those 7 villains. So why do interest rates matter? You take away from this short video, the reason why interest rates matter is investors, whether they're looking at stocks, at bonds, or real estate, or a business, what they're trying to do is they figure out what is today's value in terms of the future cash flows. So they estimate, in the case of a stock or a business, or in the case of an interest rate, or a bond, I should say, they know what the interest rates will be on the bond. But then they have to discount. They have to divide those future cash flows by an interest rate. And that's the interest rate that people are using. And if this R goes up in value, then obviously, and you're doing a division, then the current value of those future cash flows goes down. So mathematically, interest rates have a negative impact on all asset classes. The speed, I talked about that earlier, the speed at which interest rates, so not only have interest rates gone up dramatically, but it only took basically under 5 months for the interest rates rise to happen. Historically, in the past, it's taking as long as 3 years to walk down the same path. So for investors, the rise has been dramatic and the speed has been dramatic. So what do we need for a market recovery? Well, we need the central bank to what we call it as pivot. So to pivot away from rising interest rates to perhaps even lowering them. I would argue that the central bank pivot in this case would be for them to stop raising interest rates. We have low valuations. In the longer video, we've gone through how stocks are quite cheap. Improving earnings, we don't have that yet. We obviously need to come out of a recession to have improving earnings. We need some sort of geopolitical clarity, not necessarily peace per se, but just a path forward in terms of all the geopolitical issues that we're seeing, whether it's the war in Ukraine, the energy crisis in Europe, and a whole host of other geopolitical issues. For the past decade or even 15 years, policies issued by governments have been not focused so much on economic growth or economic prosperity and towards other issues. Good, bad, or indifferent is irrelevant. The point here is that the policies are not pro-growth in terms of economic growth. So until that changes, I'm afraid that stock markets will have a tough time. problem-solving mindset, that is always part of the recovery. So if you stop and think about it, companies that are dealing with high labor costs are finding innovative ways to get around the problem. Innovation and ingenuity, that's also another way to get around it. And so the last two items are very, very important. If you look at all previous past recessions coming out of it, the innovation sector, the technology sector have always led us out of a recession. So what is Immutable? Well, we know we want to stay on a dividend-focused path, or at least a share buyback, or in focusing on companies that have share buybacks. We want a quality balance sheet, meaning not too much debt. We want to focus on companies that have proven they're good. Maybe new management that comes in with a great asset and have a concrete plan. Global approach. We want to focus on companies that can grow not only inside their borders, but outside. Valuation. We don't want to overpay for stocks. And finally, we want to stay away from headlines, and we don't really want to be swayed by the current narrative too much. We've made some adjustments. Rising interest rates obviously changed certainly the asset classes and how we approach stocks and the valuations. And we want to focus on and continue to work on our research around the impact of higher housing, in this case, currently receding housing prices, inflation on consumer discretionary income. We want to look at migration and demographic paths, and then continuing on housing prices as they have an impact both on the banking sector, but also in the consumer spending sector. And we want to look at the recovery in the different stratas of demographics to see how both the recession and the eventual recovery, how they're being impacted. And finally, as I mentioned earlier, government policies are very important in terms of the path forward. Understanding them is capital to developing an investment strategy. Thank you so much for watching. I'm Benoit Paliquin. If you have any questions or comments, we would love to hear from you.